As we have discussed in this chapter, if a company wants to increase its sales growth, it's also going to need to finance a growth in assets, and it can do that either internally or externally. In this more complicated pro forma, we're going to examine the link between our income statement and our balance sheet that exists not only through retained earnings, but also through a link between our interest expense and our company's debt financing. We're going to begin by assuming that sales for simple sales will increase by 10%. So sales will go up to $11,000 the first year. Our cost of goods sold will go up from $9,000 to $9,900. And our gross profit will simply be, again, the difference between sales minus cost of goods sold. It will go up also by 10% to $1,100. We'll assume a similar 10% increase in our selling and admin expenses to $770. Now our interest expense, we don't want to assume just a 10% increase in interest expense simply because sales have gone up. Interest isn't driven by sales, but rather it is driven by debt. So we need to calculate our interest expense, and we're going to assume our interest rate is 10%, so we're going to want to multiply our 10% interest rate by the amount of debt we have on our balance sheet. But right now you can see on our balance sheet we have no debt for 2012. So we need to do something to start with. As a starting point, we'll just assume that we have the same amount of debt that we had last year, $1,000 in debt. So our interest expense will be 10% times 1,000 or $100. Our income before taxes then will be our gross profit minus our selling and admin expenses minus our interest expense of $100, we have income before taxes of $230. With a 30% tax rate, our taxes will be $230 multiplied by 30% or $69, and we'll have net income of $230 minus 69. We'll have net income of $161. If we have a dividend payout ratio of 40%, our dividends then will be 161 times 0.4. Our dividends will be $64. Now let's go ahead and take a look at our balance sheet. Again, we've basically assumed a 10% increase in sales will also require a 10% increase in cash, receivables, inventory, and plant and equipment. So our cash will go up to 220, our inventory to 330. Our accounts receivable to 330, our inventories to $660, and our total current assets will equal $1,210. Our plant and equipment will also assume will go up by 10% to $880, and our total assets will increase to $2,090, a 10% increase. Now if we buy 10% more inventory, we can expect our accounts payable will also go up by 10%. So we'll go with 330 for accounts payable. If we're selling 10% more, we're going to have 10% more employees, and our accrued wages will probably also go up by 10%. So let's put in 110 for accrued wages. So we have total current liabilities of $440 plus our $1,000 in long-term debt that we were going to assume. That gives us total liabilities of $1,440. Again, long-term debt will end up being our plug because it doesn't increase just as a function of sales. We have to actually go out and borrow money if we want to increase our long-term in debt. The same is true about common stock. When sales go up, common stock just doesn't magically increase, so we'll leave it at $100. Our retained earnings, remember, will be equal to our beginning retained earnings, which was $400, plus our net income of $161 minus $64 in dividends. So we've got retained earnings of $497, and our total stockholders' equity is $597, which means our total liabilities and equity are $597 in liabilities and in equity plus $1,140 in liabilities. We have total liabilities and equity of $2,037, and we can see very quickly our assets minus liabilities and equity. Our balance sheet doesn't balance. Our balance sheet right now is off by $53. This means our long-term debt instead of being $1,000, really should have been $1,053. And had we entered $1,053 for our long-term debt, then we can see our balance sheet would balance. Let's go ahead and now look and see how that change in long-term debt from 1,000 to 1,053 will impact our income statement. So let's go ahead and do a second iteration. Again, sales, $11,000. Cost of goods sold, $9,900. Gross profit, $1,100. Our selling and admin was up by 10%, again, $770. Our interest expense now is 10% times whatever number we have on our balance sheet for debt. And right now we have $1,053 for long-term debt. So 10% times $1,053 means we will have interest expense of $105. Our income before taxes then will be our gross profit minus our selling and admin minus our interest expense. We will have $225 in income before taxes. Our taxes then, again, taxable income times our 30% tax rate. Our taxable income, or taxes, will be $67, and our net income will be $225 minus 67. We'll have net income of $157. So notice, as our long-term debt increased from 1,000 to 1,053, that caused our interest expense to go up, which makes our net income go down. Our dividends will be our 157 times our 40% payout. Our dividends will be $63. So let's go ahead again and take a look at our balance sheet. Now, total assets, again, we'll just skip ahead and just put 2090 here because we'll have no change in our cash, receivables, or inventory. Our accounts payable and wages payable, those will also be the same as last iteration. Our long-term debt, though, we said from last time it would be 1,053. So let's put in our 1,053. Our total liabilities and equity then, 1,053 plus our 440. We have 1,493. Our common stock, we said there'd be no change, 100. Our retained earnings, again, is our beginning retained earnings, which was the $400 from 2011, plus our $157 in net income, minus our $63 in dividends. So our retained earnings now is $494, which means stockholders' equity will be $494 plus 100, $594, and we can see our total shareholders' equity and liabilities will equal to $594 plus total liabilities of $1,493. We get $2,087. And we can see once again our balance sheet doesn't balance. We're now off by $3. Again, the reason for this is because as debt went up from 1,000 to 1,053, our interest expense went up, which means our net income goes down, which means the change in retained earnings is lower. Retained earnings basically went down by $3, and so that's why we now have a $3 difference. So obviously we can see the only way we would make this balance sheet work is if instead of having $1,053 in debt, we had $1,056 in debt. Problem: as we increase our long-term debt, it no longer ties directly in with our income statement. We could go through a third iteration and get a little bit closer, but you can see the process. As we increase debt, interest expense goes up. As interest expense goes up, retained earnings goes, net income and retained earnings go down, and so our debt will also go up. There is a link between our income statement and balance sheet through both retained earnings and through long-term debt and our interest expense. All right, let's take a little bit closer look at that link between our interest expense and our debt. We've got a simple pro forma here. We've got some projections for revenues and costs for the coming year. We've got a beginning balance sheet, and we're going to need to put together an ending balance sheet. Let's go ahead and calculate some values here. Our Earnings before interest and taxes will simply be our revenues minus our costs. Our interest expense, we don't have a number for debt yet, but it's simply going to be our interest rate multiplied by any debt balance. Our interest rate is 10%, and our debt balance will be right over here in column I. So let's put in a formula equals our interest rate multiplied by the debt balance. Not there yet, but notice as soon as I put something in for debt, if I put $1,000 in, we will have interest expense. For now, we've got nothing going on for debt. Earnings before interest and taxes then will simply be our earnings before taxes then will simply be our EBIT minus our interest expense. Our taxes will simply be our earnings before taxes multiplied by our 30% tax rate. So our net income then will be our $4,000 in taxable income minus our $1,200 in taxes. We have $2,800 in net income. I've already assumed an increase in assets. I've given you an increase in current liabilities. Those are just given. So let's go ahead and pick up our ending balance for equity. We're just simply using one equity account rather than common stock and retained earnings, but our calculations is going to be basically the same. It's going to be our beginning balance plus net income minus dividends. In this case, we've got 0 for dividends, so we'll hit enter. So we're going to have $9,300 in equity, and we're going to need a number for debt. Now, let's go ahead and add up 93 plus, we've got nothing right now for debt, plus 680 in current liabilities. We've got $9,980 in total liabilities and equity. Our total assets are $14,000, so the difference between $14,000 minus $9,980 is $4,020. So let's go ahead and put in $4,020 for our current or our debt number, 4020. Now notice, as our debt number went up, and let's do that one more time. As our debt number goes up, watch what happens to interest expense and net income. So as debt goes up, interest expense goes up, net income goes down, and ending equity also goes down. Let's see that one more time. Right now, ending equity is $9,300. Once we put in the debt number, it goes down to $9,019. But notice, our balance sheet still doesn't balance. We had retained earnings go down, so we need to borrow a little bit more than $4,020. We need to borrow an additional $281. So let's put in our $4,020 plus $281. And again, let's watch what happens to our net income. It will go down from $2,519 down to $2,499. Our retained earnings or equity also goes down. And so once again, we find our debt plug. We're still not quite there because of our increase in interest expense, decreased net income, decreased retained earnings, which means our debt plug had to go up. So we need an additional $20 now for our debt plug. So let's put in the additional $20. And hey, we're getting closer. We still had a small change in net income because of the small change in interest expense. Let's put in another $1 for debt. So instead of $43.21, let's put in $43.22. Not quite there. Still off by $1. Instead of $43.22, let's put in $43.23. And we basically have a pro forma that balances. That took us about 5 iterations to get there, but one thing we notice, we really aren't there. If we were to increase the decimal places here, our balance sheet still doesn't exactly balance. Fortunately, we can make use of Excel's iteration capacity, that it will go through a number of iterations on our worksheet. Let's enter a formula for debt, because notice we were taking debt with simply our plug. It was the difference between total assets, current liabilities, and equity. So let's put in that formula. Equals assets minus current liabilities minus equity. Wow, we've got a warning here. Circular reference warning. One or more formulas contains a circular reference and may not calculate correctly. Okay, and here we've got some stuff going on, and Excel certainly, it's telling us that, what do you want me to do? I need to know debt to calculate interest expense, to calculate net income, to calculate retained earnings, but you've told me that debt is dependent upon retained earnings. So we've got this circular iteration going on here, and the logic can't be completed. So what we need to do is we need to tell Excel we know we have some circular logic, and we would like it to go through more than one iteration. To turn on iterations, you can go up to the Office button, come down to Excel Options, and under Formulas, we're going to select Enable Iterations. And to start with, I'm just going to put in 2 iterations, and I'm going to hit OK. Now notice, let me get rid of reduce my decimal places here. 2 iterations, I'm off by $303. My balance sheet still doesn't balance. If I hit the F9 key, Excel will calculate and go through 2 more iterations. I'm down to a $21 difference. 2 more iterations, I'm down to a $1 difference. 2 more iterations again. Every time I hit the F9 key, it recalculates. So after these iterations, Excel settles into the right number. So again, all we need to do is enter our formula, equals assets minus current liabilities minus ending equity, and boom, we've got it. But again, that was 2 iterations. What would happen if instead of setting Excel for 2 iterations, because computer time is cheap, I set it for 100 iterations? So go up to the Office button, Excel Options, Formulas, Enable Iterations, and let's set it at 100 iterations. And I can hit OK. Now when I enter my formula, equals assets minus current liabilities minus ending equity. Let's see, I must not have set something. Excel Options, Formulas, Enable Iterations, OK. Now when I enter my formula, it's already done it for me. It has gone through 100 iterations, and I now have a balance sheet that balances. My interest expense is linked to my debt. My net income is linked over to my ending equity.